actually now.
Rob says we're not, but Rob Brayton, I'm
Okay.
talking to him on YouTube.
All right. People of the live stream, okay, we're live on Facebook.
Okay, let's go with it then.
Okay. We are live. So good morning and welcome back to the Money Advantage podcast. We have two things for you. Sorry for the little rocky start because the technology was not exactly working well, but we have a really awesome conversation for you today and from a whole slew of people. So I've got a new face to introduce to you who's never been on the podcast before. Jeff Jesse, welcome to the show. Oh,
One
you
time.
have been one time. Okay, yes, I'm sorry. I have misspoken. We've got Becca Wilhite, Joe DeFazio, and Bruce, my awesome co-host. We've been doing the Money Advantage podcast for like a long time. Uh,
Yeah, over 7 years. Yes.
yeah, I was gonna say decades, but not really decades. All right, so today we're talking about what are the real risks of infinite banking. So this is an interesting conversation, and partially because we have a take on this that we hope to really just be able to share with you that is going to enlighten you and put a perspective to make sure that you're helping you to make good decisions. But I think a lot of times people come to the idea of anything new and especially the idea of infinite banking where maybe they've heard something online, they've heard from another marketer, they've heard from somebody who's in the infinite banking space or somebody who's maybe disparaging infinite banking and they have these ideas about what it is and what it isn't. And there's things that our minds immediately jump to, like what are the cons, pros and cons of something? What are the risks? What are the downsides? What are the traps I can get stuck into? What might not be good about this thing? And so we're going to unpack that today and really hope to share this broadly with you. I'm going to ask who would like to kind of just jump in on this topic. Where do you think this idea that infinite banking has risks comes from? Jeff, I see your face. I don't know if you want to jump in on this right away, but anyone, this is open conversation here.
I'll start by saying that I think the biggest risk is that people are not talking about infinite banking when they think they're talking about infinite banking. Um, they're they're not talking about banking. They are comparing apples and oranges regularly without naming any names. You look at somebody talk about something in this space, and you actually look at what they're talking about, and it's a very different thing. They don't understand the problem. So since they don't understand the problem, then they're mischaracterizing from the get-go.
So the thing that often gets thrown in as infinite banking when people say, "Oh, there's big risks of infinite banking." Let's just kind of blow up the elephant in the room here. Most people think whole life insurance. What are the risks of life insurance? And the mind immediately goes to, oh, there's going to be high premiums for a long time. What if I can't pay that in the future? Oh, life insurance is a bad investment, especially whole life insurance. It's a low rate of return. And these end up lumped into this idea of, oh, that's a risk of infinite banking. Therefore, infinite banking is not good because I don't like whole life insurance. Or I heard somebody at some point say that they didn't like life insurance. And that kind of gets all muddled together. And I think, Jeff, you're really onto something. You're talking about linguistic theft. This idea that words don't always mean the same thing. People don't know exactly what the terminology and the definitions are. So, um, Joe, would you love to share with us what is infinite banking? Just like a super basic overview so that we can kind of clear the air here and make sure that when we're talking about risks of something, we're actually talking about the actual matter at hand.
What is infinite banking? Um, I think Nelson, in his fifth edition, he says the idea is to recapture the interest you're paying for the things you're purchasing in your lifetime. Infinite banking is the process of recapturing that benefit that is going to someone else for yourself. I think, um, yeah, infinite. It's really simple once you understand it. It's really difficult to condense it without muddying the water, just as with this linguistic theft. I think people do combine life insurance with this concept, but it's helpful to keep it distinct and say banking exists outside of life insurance. So what is bank? If we're going to understand infinite banking, we have to understand banking. Banking is related to the flow of money, right? Money comes into your household, money gets stored up somewhere, it gets deployed, and then it gets replenished. That's the full cycle of banking, at a very, very basic level. The infinite banking concept is to say when you own that cycle for yourself and your family, there's infinite possibilities of what you can do. Like you have complete autonomy, you have complete control. I think when you combine that with the proper product, which in 2025 and has been for 200 plus years, is participating whole life insurance from a mutual company, the attributes of that enhance the banking. Right? They add this extra layer of protection that is, it insulates you from inflation. It insulates you from taxes. It keeps, like, you're partnering with a company because it's mutual that you co-own. So you keep control while you're delegating, which in anywhere else in the financial world, when you delegate, you also lose control. That you co-own. So you keep control. I think I heard it myself as an
I'm
echo.
pretty sure we heard you twice. That's the other
Just to
joke.
reemphasize that in there. And then the other piece of that whole life allows you to perfectly calculate. It's like a perfect ledger for opportunity cost. Right. So we all know you finance every purchase in your life, whether it's you borrow for someone else or you borrow from your future. There's interest involved, there's payments involved. But most of us are dishonest and do not add up the payments or the interest we owe to ourselves. That's why we love our savings account. We take $100 out, in a year later, we'll put $100 back, regardless of what the interest should have been, regardless of what we should have put back. That's what we feel is just for ourselves. We violate EVA in that sense. We don't respect our own capital. But life insurance,
economic value added, if someone doesn't know that word. Yeah.
So life insurance built into it has this it's a measuring stick for that opportunity cost. When you borrow, it says, okay, we're going to start the clock to say, this is how much interest you should also pay back when you pay back this amount to your system. I'm trying to speak broadly. Whereas your savings account doesn't tell you how much to put back. You could take 100 out and only put 50 back. And no one's going to tell you that you forgot to put the other 50 plus the 5% that it would have grown. So it's it's like a perfect bookkeeping for opportunity cost while it's handling these other issues. So sorry, that got
Joe,
really
that's
complicated, but
no, that's awesome. And I think, I mean, if we just come back to the beginning of what you said, infinite banking is not life insurance. Life insurance is a tool to satisfy infinite banking. But if we don't understand the problem first, if we don't understand what banking is, we can't even begin to discuss concern about life insurance and lay that over like I don't know, remember those transparencies like way back in the olden days when you had like this thing you'd put up on the projector screen. This, you can't overlay this other transparency of life insurance on top of infinite banking and call them the same thing. We really do need to isolate them, separate them, recognize the difference so that we can really talk about what are the risks. I mean, there are, yes, pros and cons to everything. And there's a balancing. There's things that you can gain and things you can lose. But if we're not even talking about the right definition, or we're not talking about the same definition or the same thing, it can be really difficult to have an effective conversation. I'm learning this. My daughter is studying logic for the first time, formal logic, and everything starts with a definition. So that's why we are isolating banking from the life insurance conversation. So when somebody says there's risks of infinite banking, let's first talk about, are there risks? What are the risks of actual infinite banking? What are the risks of life insurance? And how can we understand the lay of this so that we can actually make decisions rather than being stuck in fear and paralysis when we just hear problem, fear, run away, bad thing, and we go back to what we are used to and what's familiar to us because it's comfortable. So
Can I do one more?
Yes.
So if we start with banking is a principle. So gravity is a principle. You jump off a building, you fall to the ground, right? Banking is a principle. Banking is everywhere. Banking, every dollar goes through a bank. So whether or not we understand the principle doesn't change the fact that the principle is the principle. Banking is a principle. So if we have to have a basic working understanding of what banking is. Life insurance is a tactic. So we can't opt out of the banking system. There is no mechanism to completely opt out of the banking system. There's no mechanism to opt out of, even more so, banking as a function in a person's life. So if you look at banking just from a monetary perspective, it's accumulating capital to go put that capital to work to hopefully have that capital bring back, replace itself and replace itself with more. But we could look at banking from the perspective of almost any domain of life. You could look at it in relationships, right? We capitalize a relationship, right? We deploy that capital in a relationship and we hope that that capital brings back more and we're pouring more into that relationship, but by pouring more into that relationship, more comes back. How much would you want to pour into a system from a banking perspective, whatever that good system in your life is? How much more would you want to pour into that system if it's good for you, for others, and it's bringing back more than you put out? Kind of like you could almost think there's a biblical principle around that, maybe. Um, so if you think about that from a principle perspective, then you start to look and say, okay, am I a banker? And I think by definition, every single person is a banker. Then you start working your way through, do I realize I'm a banker? What kind of a banker am I? Am I a good banker? Am I a bad banker? Who am I banking for? Am I banking for other people? And is my banking activity making other people wealthy and building their dreams? Or is my banking activity building my dreams, building my family's dreams?
Becca, I'm sure you have something. Oh, sorry.
I was just going,
Go
I was
ahead.
going one more than then we start talking about life insurance. But we talk about life insurance way, 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 way too early before we even understand why we would be talking about life insurance. And that's why life insurance, the questions about life insurance exist. Because if you understand banking, then you just start looking to say, since I am a banker, how do I bank effectively? At that point, let's talk about life insurance, but we shouldn't be talking about it before that.
Absolutely. So I'm going to pivot to you, Becca, and then Bruce. So I think just for the simple purposes of somebody who's coming to this conversation, who might even say, okay, I'm a banker. I mean, I didn't realize I was banking. What is this even about? So, Joe, you kind of started with, you're putting money in, you're storing it, you're taking it out, you're replenishing. If you simply think about money is being stored somewhere, and usually what happens is we are putting our capital after we get a paycheck or we get money coming in, we're putting that somewhere to store it. The storage unit for that money that we have for our income is usually the bank or a bank, and we're putting money in the bank. Why are we doing that? We're putting it there because we need to store it because you're not going to use it instantaneously. You want to have it available for when you do want to make a purchase. And so, I mean, you could even think way back fundamentally about what money is at all, because it's really this store of value. You have these dollars that are coming into your life and you say, okay, well, I want to store that value because maybe I'm going to need to purchase something tomorrow or the next day with that money. And so you're not using it right away. It's coming in, you're going to maintain it somehow, somewhere, someplace in order to deploy it later. The question, so that's what banking is. It's the storage of the money. But what we're saying here is that there is options for where you store that money. And when we think about putting money somewhere so that we can use it later, normally the typical way of doing things is just what everybody is doing. The way that the world seems to work, we're a customer of the bank. The bankers who are running the banking system are getting control of that capital. It's being held in their storage tank, which means they are earning the interest, they're earning the returns, they're earning cash flow, they're getting leverage, they're getting arbitrage, they're in control. Why? Because somebody has to store the capital, and they said, oh, I'm going to capitalize on this opportunity that everyone needs to store capital. How about instead of recognizing that somebody has to store the capital, we can take ownership of that and then get all of those benefits of becoming the banker, stepping on the other side of that table and not just being a customer of the bank. So, Joe, I see you.
But Rachel, I have a question. If I didn't know any better, but I started my own account for myself, what do you mean I'm banking, or what do you mean I'm helping this banker make all this profit? What are you talking about? That's
Oh, yes.
I can look at it and I can see it on my papers and my online account. It's what are you talking about?
Ah, okay. So this is a good question because I think, yeah, let's go there. Okay, so we can unpack this and Bruce, we still need to bring you into the conversation here. So we okay, so we're in a position then of saying just because your name is on the title of that bank account and it says that's Rachel Marshall's bank account. I don't own that capital. The bank, we're not going to name any bank names, but you all know them. They're the big, huge, giant buildings with the tall skyscrapers and the big, huge gold letters on the top of them. We all know these banks. We're putting our dollars in their control. Now, I can, if I'm having my account at XYZ Bank on the street, I can go in and I can take those dollars out, right? But I can't have the ability to control that capital. And I'm in a position that if I'm going to control capital, I need to be able to not just have my name on an account, but I need to be able to leverage against it. I need to be able to earn while it's sitting there, not just earn what the bank is going to pay me in interest so that they can use my money and actually they're deploying it, putting it to work in sending out in loans for other people. I need to be the one who's making the decision of who's going to access the capital, not just who is going to have the name on the account. Joe, would you further elaborate on that?
No, that's great. And I think it's a shock for most people when they realize, one, the banks aren't your friends. The banks are not fiduciaries to you. Right? They're there to generate a profit for the owners of the bank. If you're looking around and you can't see any products, that means and this is a really strong word, but they're extracting the value from the depositors for the benefit of the owners. So everything in that system is designed to make the owners more profits.
And are you the owner? If you have
Are
your,
you the owner?
yeah.
So
No,
I
you're
want to
not the
introduce.
owner of the bank.
No, you're not. No, you're not. You're. I wanted to introduce this framework that I use for people. I call it 4 Ps, like can of peas, tribute to Nelson Nash. But it's perspective leads us. If you have the right perspective, it leads you to the right problem. If you identify the right problem, we can identify the process that we need to fix. Once we have the correct process, now we're ready to figure out, what product fits the right process that solves the right problem because we have the right perspective. Right? It's really easy to show people in a bank they thought they owned something, their bank account. But when you peel back the layers of the onion here, you're not in control. There are some things like FDIC insurance for your bank. I don't want to scare anybody yet. They will guarantee that they will pay you cash up to certain amounts. There's no one's stealing your money, but for example, you said it kind of cavalier. You can go in and take your money out. I would say go try and take 100 or 200 or $300,000 out of your bank account. Watch the amount of paperwork, the questions you get, how long they delay, and if they by their own definition say there's anything wrong with this, how long they can freeze that transaction or all of your accounts.
Well, also, I mean, if you look at the idea of a run on the bank, and we're again not trying to preach fear, but if every depositor in a particular bank asks for all their money out at once, it's physically impossible. There is not the capital at the bank because they're using a fractional system. So you can't access all your money, which means you're not an owner,
Yeah.
which means you're not in control.
Which means you're not in control. Yeah. You like when you really consider the control is so important, and we're just taught to kind of like dismiss it. It's so important in your financial world. But every time you give your capital to another institution, if it's not a mutual institution, exclusively a mutual institution that practices mutuality, it's like it's when they benefit, you don't. When you do, they don't. And if they have all the cards, which way are they going to stack the deck? Not to your benefit.
So to be
We're going to
clear,
make it.
we are talking here about the product, which is a few layers deep into this conversation. We're not talking about infinite banking. We're actually talking about the product that you would use for the purpose of banking. But
Well, I was going to say I'm qualifying first the entity before we get to the actual contract, life insurance. The company you want to partner with can be a bank, which is not a mutual company. It's a stock company, and they are beholden to the stockholders, the owners of the company. A mutual company, the customer is also the owner. So you have to serve the customer. You have to, by the bylaws of your company, serve the customer. Mutuality, meaning the fiduciary standard, is baked into the structure of the company. Every decision will be done with you on the same side of the table because they're trying to serve the owners, which also happen to be the customers. That does not exist in a stock company. No matter how much they promise and say, I promise I'm a fiduciary. It's not the same as when you're forced to, on every level, having to and naturally will serve the owners of the company, which are also customers.
so that's a good test. Am I an owner?
Am I an owner?
Not, yeah, not in the banking system, but in the life insurance space with a mutual company, yes, you are. So, Becca, I'm going to pivot to you for a second, and then, okay, so Becca, as you're kind of looking at this whole lay of the land of people saying, "Hey, there's risks about infinite banking, or there's that concern with that." What are your thoughts surrounding that in terms of how can somebody think effectively and clearly to be able to really understand what the question is here?
Yeah. Well, I think it's natural anytime you come up with a new idea or a new thing that you're going to do to scrutinize that, right? But what I found is that a lot of people put such a level of scrutiny on life insurance that they would not put on their current system, right? So, well, what if the dollar fails? Well, what if this? What if this? What if the economy collapses? And I think it's important to look to your current system and ask those same questions. Like what would happen currently, right? So that's one thing that comes to mind. And then kind of going back to what Joe was saying about perspective, about starting from the right place, from the right, from looking at it in the right. Have you ever seen this little cartoon? This is one Joe uses sometimes, where you have a six on the ground and a little man standing here, and then there's somebody else on the other side, and to them it looks like a nine, and so they're arguing back and forth. It's a six, it's a nine, it's a six, it's a nine. No, they're both right, right? But it depends on the perspective that you're coming from. And so again, that perspective of being a bank owner, most of us ask our questions from the perspective of a consumer. So then we talk about, well, why would I pay interest on my own money, and what's the rate of return, and all these questions that we've been taught to ask. Whereas if you step to the other side of the number and look at it from a different way, if you have on your banker hat and you're thinking like an owner, all of a sudden, some of these questions you were asking before don't even matter. And you're seeing them totally differently because you're owning this system that you're participating in. And so I think that's really, really crucial as we start, because when we start out, we don't know the right questions to ask. We are completely, when I first found out about infinite banking, I was completely unqualified to even know what questions to ask. And so I asked the questions I had at my disposal, right? Which are those same ones. What's the rate of return? How much interest do I have to pay? What could go wrong, right? But that's why I think, back to Joe's point, it's so important to start with the correct perspective, solving the right problem, using the right processes, understanding that we're solving for banking. We're not solving for these life insurance. And that's important too, right? It's important to know about life insurance. But yeah, I think your perspective and even like the seen versus the unseen, we gravitate towards the seen. I can see I can see the bills I'm paying. I can see the interest that I'm paying on credit cards. I can see all these things. But have you ever calculated like the opportunity cost on the spending, on the cash that you spend? Like we calculate interest, right, that we pay to others. So we see that, but we don't see what we're giving up on the other end. And so that just goes by the wayside. But that's a huge factor that we need to pay attention to. So I don't know, that was a lot of kind of random thoughts, but these are the things that
No,
have
this
been
is
running through my head.
awesome. I think, first of all, I think everyone comes with their questions with where they're at. And most people, yes, are asking questions about life insurance because that's the question that makes sense to them, and they need to be able to understand that question in order to maybe get into a position of thinking differently. But I think the shift really that you hit the nail on the head, Becca, was shifting from being a consumer, which if you're going to ask consumer questions, you're going to buy, I don't know, it pops into my head a horse. You're going to buy a horse. Okay, is this horse sound? What's their pedigree? Are they lame? Yeah, we bought horses growing up. I was a barrel racing. We went to auctions and I was like, you had a few minutes to be able to figure out which horses you want to buy. And then you would see them in the ring and the auctioneers doing the bidding and everything. You're like, okay, I like this, but no, I don't like this anymore and not for that price. So if you're going to evaluate purchasing something or putting your dollars into something, you need to understand, is it is it sound? But if you're but as an owner though, you might be looking differently. I don't even know how to extrapolate that example onto the horse, but if you're just thinking about like I'm going to buy this horse and it's going to be my property, that's different than thinking about I'm going to own something, I'm going to be in control of this, I'm going to control um I don't know if my analogy is working, but I just loved your shift from consumer to owner and the
What
questions that you asked that are different.
what if you said what I mean, I don't know horses, but this the thing that comes to mind is if I'm a horse breeder and I'm wanting to breed and start a horse breeding business, I might be looking at different things than if I'm a barrel racer, right?
That's
Like
true.
there's different
No, that's
maybe that
true
works.
because you're
Hey,
going to look at bloodline and you're going to look at like longevity. You're going to look at how many other champions were bred through this bloodline, and you're going to be evaluating on that rather than just the tactics of how they look running or how their body
Hmm.
moves. So yes,
Hmm.
but it's the same thing if you're going to shop at a grocery store. Hey, does this feel clean? Am I taken care of well? Are they answering my questions? Like, do I feel like I can buy what I'm looking for? Versus the owner of that grocery store is going to be making decisions on how do I want to make my customers feel? Is it profitable the way I'm running things? How do I attract more of the right buyers? How do I ensure that this operation can not just make everyone happy today and go out of business tomorrow because we didn't make any money? They're thinking completely differently and making decisions from a bigger perspective. I think that's really what the consumer to the owner is. The lens is so much broader. Okay, so now that we've got all these areas going, Bruce, I need to bring you into the conversation. We want to get to the point of the perceived risks of life insurance. I don't know if we're going to land there in this conversation, but Bruce, what are your thoughts about this whole thing?
Yeah, I don't know how many of our listeners are celebrating that I haven't talked in the first 25 minutes of the podcast.
Probably not celebrating. They're
Um,
probably like, where's Bruce? We need to get Bruce talking.
um, no, I think what this shows, and yes, I've been trying to evaluate because I'm always trying to evaluate what the listener's thinking, and I think what this shows is that unless a person wants to educate themselves on economics in general, and banking being a big part of economics, they don't deserve to take the banking function into their lives because it's not going to work. And I've made this comment before, not only on the podcast but at the Nelson Nash think tank, and it was probably the one thing that um, stirred up more things that I've ever said before, with people actually coming to me and saying, "Yeah, I never thought about that before." The problem, we live in a TikTok generation where we would have had to have something like what 36 consecutive 1 minute TikToks on this particular podcast, and people are not going to watch that. They just want to know what I should do in 1 minute, and that is the difficulty of this. I mean, I had so many things. So first of all, if you keep doing what you've always done, you're going to keep getting what you've always got. And so when people look at why are they looking at the infinite banking concept? Well, they're looking at it because something in their life is a mess. And so that's the first thing that I recently started to think about. It's like, why are people even approaching people, not only our group, but other groups? Why do they want this? Do they want it because I personally think that a lot of them want it because they think it's a get rich quick scheme, because that's the way it's actually projected in a lot of things. Nelson would say, no, this is a way of life. So one of the risks I wanted to talk about today was the biggest risk I see is people say, I want to just try this and see if it'll work. You can't just try it. You have to make it a part of your acumen in your life, your way of life. Um, so because if you don't, then you're going to not value your capital, which Joe said, which I think is one of the, I mean, I always knew it, but it's one of the aha moments I've had later in my career, is that people don't value their own capital. Um, and if you don't value your own capital, you're going to do the law of, you're not going to take into consideration the law of large numbers, which is your entire life. You're just going to say, oh, look, I tried this one time and now I didn't get a very good rate of return, and well, I should just pay cash for it. Now I have to pay this premium, because it's just this. They're just taking things out of their lives in little minute little time periods, and
It's the
that is
scene. It's the scene, physical
right.
things. It's easier to understand.
And the other thing I try to prepare for today's podcast was to say, what does risk even, I mean, I think we opened up, what does risk even mean to one person and another person?
Mm.
you know i to some people say, well, the risk of me losing 34.5% value of my money to somebody else, I don't really care. I just like to make it simple. I just want to go to a bank.
Mhm.
I just want to make it simple. That risk isn't important to me. So other people say, well, not only do I want to capture that 34.5% of volume of interest flowing out to another institution, they also want to try to stop inflating our money supply so that the United States actually gets in a sounder financial ground, instead of being beholden to this debt crisis that we have. There are people that actually think about that. And I think you had it on one of the questions we talked about, we were going to talk about today, is why does this seem to be attracted to the as odd or countercultural, and that would be the Austrian way of thinking, or the libertarian way of thinking about this. And some people are like, those people are weird, you know. Well, those people are weird to you, just like they're not weird to other people, just like some people see risk one way and some people see risk another way. So I guess to wrap this up, I do think that the number one thing a person has to say to themselves is, am I going to change the way that I view this? And am I going to continue to look at it my rest of my life, just like Nelson looked at it his entire life? He made it his life's work. So that would be my opening statement 30 minutes into the podcast, is that
That's
is
awesome,
that
Bruce.
this is very difficult, but if you don't embrace the difficulty, you're not going to embrace the value of it.
Bruce, that's beautiful. I think I'm just going to add on to what you shared, and I think this is going to help us to even go towards the next piece of what we need in this conversation. But I think there's a huge temptation to look for silver bullets everywhere, because we want easy, we want fast. And the challenge with that is, I actually heard it in one of Russell Brunson's books. So I have basically all the books he's written, but there's Expert Secrets, Traffic Secrets, Marketing Secrets. I'm not even sure which book it was, but he was talking about this idea that most people, when they start in business, they want the one quick fix. They want the one strategy that's going to work. They want the overnight success. And everyone hears about that business that started, that was an overnight success. But what they don't see is the entire backstory that usually it took 20 years to become an overnight success. And nobody wants to go through that hard journey. But Russell was really, really transparent about this idea that if you're going to build a successful and lasting business that actually serves people and is wildly successful, it's going to be a long haul, it's going to be commitment to principles, it's going to be it's he wasn't saying, this whole like you have to hustle and grind. It wasn't that. It wasn't the like hustle versus easy. It was commitment versus expecting this like magic thing to happen. And commitment to something means that it might take a long time. You're going to have to stay committed even when things don't look like they're going well. And so I guess what I'm saying about, I'm going to overlay that to the idea of infinite banking is that often when people are looking at tangible, tactical, practical, physical things in their financial life that they're trying to fix, infinite banking can become a solution to them. I'm going to borrow your words, Jeff, but it's much more beautiful than what can be initially seen when you're just looking at that physical initial problem. And so it's the silver bullet quick fix versus a commitment to something. And where I think this relates to people is that infinite banking can catch anybody where they're at, but it's going to be this uncovering, this unveiling, this revealing thing that's going to become better and better and better the more you deeply understand it. You probably won't understand it fully until you get started and you start making some strides in using a policy, which is why getting started, even when you don't have a perfect understanding, or maybe you're not fully thinking like an owner yet, we're not judging you. We're not saying, hey, you shouldn't do infinite banking if you don't have a full comprehension of everything that it is. But I think that the challenge is we're talking about solving a really big problem. And most of the time people are just saying, how do I get a better rate of return? How do I pay off debt? How do I, have enough cash for that next purchase I want to make? How do I go on that vacation? How do I make sure I have enough money in retirement? How do I, you know, save for my kids' college? Those are the tactical, practical, immediate things that maybe people are trying to solve. Infinite banking can help you solve those things, but it's really much bigger than just that one small, skinny slice of your financial life. It really is something that solves so much broader of a problem because it's about that banking process and shifting over control. And so, I guess what I would say here is that for the person who says, I just need it to be simple, I just need it to be quick, I need to be able to grab a hold of this, I don't want to go read 4,000 books, and I don't want to consider and contemplate on this for the next 5 years before I take action. You can be like me, you can take action before you're ready, and that's probably the best thing to do. But you're going to realize through that process that you are opening the door to something that the risk is going down this rabbit hole is that you're going to see that the answer is much bigger than maybe the initial problem you were trying to solve. So that's a completely different perspective on the risk of infinite banking. Joe? Jeff? I see both of you guys wanted to say something.
Go ahead, Jeff.
I was just going to say two quick things. Someone is valuing your capital. If it's not you that's valuing your capital, it is somebody else. And whoever is valuing your capital is profiting from your capital. And a person you do the work, you should be the biggest beneficiary of that work. Unfortunately, the reality is if you know how to do the math, you're not the biggest beneficiary of your work. So that's one thing. Another thing is Bruce mentioned that it's complex, and it is, but there is a simplicity on the other side of the complexity where anything that you start is complex when you start. And then as you do it, it gets simpler and simpler and simpler. It gets more beautiful. It gets bigger. It gets better as you start to see it. So and the complexity is not necessarily that hard, that difficult. It's really starting at the right place. I think the biggest complexity is we start talking about life insurance too early. We start talking about MEC limits, and we start talking about policy design. We start talking about base PUA ratios. And we start talking about all these things, and people get hooked up talking about issues before they understand what they're solving for. And if you know, Nelson said, if you know what's happening, you'll know what to do. But people don't know what's happening. They think they know what's happening, and they have a perceived pain. They have a seen pain, which is nothing compared to the unseen pain that they don't even realize that they have. The pain that the banker sees. So if we can see the pain, then we solve for the right thing, and things logically take care of themselves. You don't need life insurance to be a banker, but you are a banker. So be a banker, be a good banker, be the best banker you can possibly be. That will logically lead you to life insurance, but don't use life insurance. Just understand banking. That takes care of a multitude of problems.
I think when you connect that idea, I can't remember the guy who wrote The Economic Value of Certainty. I'm not sure why I'm forgetting his name, but he wrote this whole article about when you have certainty, when you have kind of a solid ground, like a firm foundation in your financial life, a guarantee, something that you know can't be shaken, can't drop out from under you because the stock market fell, can't just be sucked out like quicksand. I mean, you're in a position where you can make better decisions because of that certainty. That's what we're talking about when you are a banker and you're in control, when you have control of your financial system, you're in a position where you can make better choices. You have more options. You can decide how to use that capital. You can decide, do I want to store the capital right now or do I want to deploy it? Do I want to use it for an opportunity? Do I want to use it for an expense? How do I want to capture the opportunity cost best on this money that I'm using? Joe, go ahead.
Yeah, I was going to say, if we go back to the 4 Ps framework, if we don't get the perspective right, one way you can start to see that is you're starting on the wrong end of that list. You're starting with product. But if you have questions about rates, if you're saying things like, can I pay this premium bill? It's like you have not adopted the right perspective first. You're thinking through the lens of paying yourself last. Meaning the marginal dollar, you're looking at how am I going to split this up? And I'm so worried that if I don't have the marginal dollar, I can't do the thing that I'm going to do, like pay premium or something like that. It's like, whereas if you're paying yourself first, that whole system flips. And if we get that perspective right, we can start saying, what's the actual goal, right? Is the goal that we're trying to absorb cash flow and manage it to our liking, or is it to build a pile of cash? The pile of cash is a consumer mindset. Like a business owner focuses on the P&L and they focus on the statement of cash flows. It's all about cash flow. Consumers, non-owners will say, focus on the balance sheet. Pile, cash flow. If you're talking about the pile in terms of the pile and using metrics for the pile, you don't have the right perspective yet to get to the point where you're talking about the product. You probably shouldn't even talk about the process yet because you don't have the right frame of mind to view this. Nelson would talk about signal and noise. The signal being the truth. The signal being, if we should all look at this like we have the ability to own our own economic energy, our own capital, right? I think Bruce just said something really interesting that the way he was defining if you're thinking long range and using a law of large numbers, there's a maximum potential for you given today. But yes, that could change in the future if you get new clients and earn more and that number all changes. But if we keep doing what we're doing today, there's a maximum potential there. You own that. Right? The way I use this to describe this is seeds. Like you have these seeds in your hands. You can plant them, grow the tree that has fruit that you can plant again. And now you can see the ripples here. The harvest gets more and more bountiful the more you keep planting it. Generationally. That's the family farm. or you could take the seeds and give them to someone else. You can give all that potential to someone else. And I don't care if that's a bunch of seeds, that will be like a one-time cash payment, or a few seeds a month, that's like a debt payment. Or I'm going to take the seeds and I'm going to stick it over here and then eventually spend them. That's like your 401k. You're giving it all away. Whereas if it's on the family farm and everyone respects the family farm and plants in the family farm and keeps, the family farm just gets bigger and bigger and bigger and bigger by default. No extra risk. No, it's just contractual. There's no risk. Like, and I say that kind of with your title here, that if you have the right perspective and you understand the problem and you implement the correct process with this product, there is no risk. If you know what's going on, you'll know what to do. The risk comes in when you break down one of those 4 Ps. You reverse the order, you don't have the right perspective, you misdefine or redefine the problem to highest rate of return or biggest cash value. You're stepping off of the signal, you're getting into the noise. There's a lot of risk there. I think what Bruce said earlier, really important. If this is going to be something you're going to dabble in, that's risky. Not risky in that the thing will blow up, but you're not going to realize the potential, or it will take so long to realize the potential, you'll get frustrated and stop. It will work, but it's your behavior that screws it up. That's the risk. Nelson would say that a lot. If the behavior drives all this more than anything. The key is not the product.
Can I add something to that?
Contract is, yeah, go for it.
Just really quick, because what you said there is the I think it actually makes a person's life worse, because it adds another piece of the puzzle to their life that they don't understand, and all that they have actually done is made their life more complex. It might work out fine, and I believe in life insurance across the board.
You mean you mean when they just dabble in it?
By dabbling.
Yeah.
Right? By not understanding the actual problem that they're solving for, and by dipping their toe in the water. And I'm not saying you have to go whole hog, but understand the problem and then determine what the right level to address the problem is. But if you don't understand the problem, you've just added more complexity to your portfolio with another asset that you don't really understand. And now you have one more thing to keep track of, one more login to look at, one more company to deal with. And I think there's risk in that just by itself that probably outweighs the benefits for most people. Because what is the likelihood, if you don't understand an asset, that you let that asset go at the wrong time? You cancel that policy, you cash it out, you don't see all the benefits that you could have realized from it had you understood what you were doing and why you were doing it.
Jeff, I mean, just to add on to that, I think that solving the wrong problem is why people get into all of the, I mean, you could call them the ditches around the edge of what infinite banking really is, or you could call them the periphery, you could call them the, I don't know, the progressive, I think I can do it better than Nelson Nash ideas, all the stuff where here's the person saying, oh, you've got to have the highest rate, the highest cash value day one, so you can, grab that money out of the policy and go put it to work in another cash flowing asset. So you're trying to redline a policy, or I think looking at saying, how do I have the highest rate of return is what then leads us to improper policy design, or looking at the wrong product, or looking at things that are.
Rachel, can you?
Yeah.
I want you to stay on the first one you said, for
Yeah.
example. I think you called it redlining a product.
Yeah.
You're a business owner. You're an entrepreneur. Not IBC, your business. Would you ever take all of the capital out of your business?
I wouldn't.
Just leave it sitting there? Like what would happen to your business? You're in, like, people miss this. You're in a partnership with the company. Your policy is part of that link. When you remove all of the capital, like what's going to happen to your business? What's going to happen the minute a headwind comes?
Yeah.
What's going to happen?
Yeah, which is the same thing. So the person, and Joe, what you're defining and describing is the person who says, all right, the only way I'm going to do infinite banking is if I can get the maximum rate of return, which means I got to put $100,000 in today. I've got to have as close to $100,000 of cash value tomorrow in that policy because I'm going to suck that $100,000 out. I'm going to go buy 4 real estate properties. I'm going to, make it rich quick. And this is the only way that I can find it to be worth it in my concept of rate of return, because that's this one small problem over here trying to solve. The problem that Joe is saying is, okay, you've pulled that money, you've pulled it all out of the policy, you now are running a maximum loan. Now you're at the risk of lots of things. Just policy collapse if you're not paying at least the interest on that. You've got a lot of challenges there. But then what happens when a new opportunity comes? It's way better than the deal you just put the money into, or you lose income. You have a bad month, or your customer doesn't pay you like they said they were going to, or they drop a contract, and now you're down income, and now you're saying, I really would have liked to have that pile of reserves. Or you have a AC unit go out in your property, or you lose a tenant and you don't have the income. You want to stay in a position where you have the capital to be able to handle like the shock absorber in your financial life. And that's the value of having accessible capital, which is way different than just solving a problem of max rate of return.
I think you can take that even a step further and just say, using Nelson's word, he was talking about recapturing interest that you do when you finance the things in your life. He later says you finance everything. So if you put those two together, that means every dollar has the same problem. He then qualifies it in the next paragraph saying it's not about an investment of any kind. And it's not about a rate of return. It's not limited to what you just described. I'm just going to do this to go invest. It is not limited to that. It's also not limited to debt. I think Nelson, in his wisdom, understanding that you finance everything, 100% of your cash flow has the problem, is infected. That means 100% has to be purified. 100%. But he knew that would like blow people's minds. So saying, what is something in the seen world that captures a lot of the problems that people can grapple with? Debt. That's where the 34.5% comes from. People can wrap their arms around that and say, oh, that is bad. But later in the book, he says, at some point, cash flows should equal premiums. When the system of policies has matured, cash flows should equal premiums. I think that can happen in a number of different ways. But he's alluding to this idea that 100% of your cash flow is infected. It's not just 34.5. It's not 5. It's
Which
all
two
of it.
things on that? One, it's going to take a while to get all of your premium dollars or all of your premium to match income. But that comes back to something Becca said earlier. And I think that it was so beautiful and so subtle that it would be easy to miss. But you said there's an opportunity cost on all of your dollars, including the ones that you spend. Can you just elaborate on that? I could do that, but I would rather you do that because I would rather bring you back into the conversation. You just say things so brilliantly.
Sure. Well, again, the seen and the unseen. We see the interest that we pay other people. But Nelson said that you finance everything you buy, right? You either pay interest to a third party or you give up interest that your money could have earned when you pay cash. Sometimes we'll say you're either borrowing from someone else or you're borrowing from your future. So a lot of times, when people get real hung up on, well, it doesn't make sense to make a policy loan or have a policy loan for that because I have to pay all this interest. And why would I pay interest, on this thing? I kind of want to say, well, have you ever calculated the lost opportunity cost, the interest that you've given up? Let's say you pay cash for a car, just for an example. Maybe you buy I don't know, what's an SUV cost these days? It's outrageous. You could spend $100,000 on a
I'm sure.
nice SUV, easy,
I'm
right?
sure.
So if you think, okay, you feel really good because you paid cash for that, but what could that $100,000 have grown to in the future? Have you ever calculated that? That's the unseen. And when you start thinking in those terms, you're like, oh my gosh, like that's a huge number out there into the future. And I think what Nelson was saying is you don't have to give all of that up. I don't know that we'll ever recapture every single bit, but in using this system, you're paying interest. You're paying interest one way or the other, either paying or giving up. So he says, let's do all this together in a system that you own and control, so that when you're paying interest, it benefits you. You're recapturing that interest, or a bunch of it, at least as much as you can, that you were giving up previously. And we have this beautiful mutual relationship, this system that we're in control of, and it's going to give us the best of both worlds.
I think when you say that, Becca, I'm thinking about, okay, so also there's an
Mhm.
opportunity cost on all the dollars that I spend for groceries, and the dollars that I spend on my mortgage, and the dollars that I spend for gas in the car that I maybe bought for cash or financed or however I paid for the car. But all the little things too, those also have an opportunity cost. And if you look at the volume of dollars that are coming through your hands and then going out to pay somebody else, there's opportunity cost on all of that. And so that's where, Joe, you're going with this idea that if you could recapture or capture, keep in your wheelhouse, if you could keep in your hands all of that money and all of what it could earn in the future, that would be the ideal position. And so if we can be towards that, then that's the problem that we're really needing to solve, of how do we capture, how do we keep and grow the maximum volume. Let me just finish my thought and then get the new one. But how do we keep the maximum volume of the dollars that come into our hands in our control, so that the most of those dollars can continue growing and doing the most for us? That's the ideal. That's the end goal. And if that's the end goal, we're going to solve that problem a lot differently than comparing technical nuances of product features. So we got to bring this plane to a land. We got a lot of things going on here. Bruce, I'm gonna ask you for your wisdom to be able to just kind of, what's the most important thing that somebody really needs to think about from this, if they really did come into this conversation saying, okay, I'm trying to understand the risks of infinite banking. I've heard a lot of things. I've heard what you guys said today. Seems like the risk is not really understanding what I'm doing. I need to have a better perspective. Bruce, how would you help that person to have maybe the most important thing that they need to take away from this conversation?
Yeah, one of the nice things about not talking is you also then hopefully think. Um, you know, Mark Twain, the great Missourian, is actually quoted, or some people don't think he actually said it, but he's credited with saying, it's better to remain silent and thought a fool than to open your mouth and remove all doubt. And what I think happens in this is that oftentimes people in the infinite banking world think they know what's happening, and they open their mouths, and they're actually, to someone that knows the infinite banking world, we can see that they're actually, just as Nelson would actually say, fools. They're fools about the concept. And so until you actually want to dive in, and as Jeff said, I agree with what Jeff says, it's ridiculously simple. You just want to take the banking function into your hands instead of someone else's hands. The problem is that in our society right now, most people don't understand basic economics. And so that's the problem. And what's even, I think, a bigger problem is that people claim they're time starved and they don't have the time to do this. No, you're value starved is what you really are. You just haven't placed your time in the right value system. And people don't want to hear that. They don't want to be challenged on that. And I'd like to end up by saying I am so grateful that Joe and Jeff and Becca came into our lives at the Money Advantage, because as I continue to look at myself reframing the message, I slid into bad habits of presuming when a person came to me, they were coming to me and they already knew why they were coming to me. And I slid into bad habits of not asking enough questions. And so getting it reframed that people just want the quick fix instead of the knowledge. I came from my perspective. I always want the most knowledge. So as Becca was saying, I was looking at it as a 9, and they were looking at it as a 6, and I was presuming they were just looking at it from the same perspective I was looking at it from. So looking at this from a consumer's perspective, they really need to take responsibility for their actions in their value systems, and not just the number system, because that's what people get caught up in. And if I haven't said final, which I usually say final several times, the final thing is and until a person gets rid of this idea of retirement, they're always going to use numbers. They're always going to use numbers because they're like, well, I want to do this because I don't want to work anymore. I want to be retired. And it's getting worse and worse and worse, where people are saying, if you do this and you save this much money and you do this, and you can be retired by age 30, you know, and people are actually making money off of this. So they're not really retired. They're actually making money from their social media posts about telling people about this, from their blogs. They're not really retired. They're just doing what they want to do. And until people actually get to do what they really want to do, they're always going to say, where's that bigger number? Because I don't want to work anymore. So you got to show me a bigger number so I don't have to work anymore. And I know that's taking this to 180 degrees, but I really believe that is a big issue with people. So I'd like to I'm not going to say final, I'm going to say finish up by saying I appreciate Joe, Jeff, and Becca for helping me reframe my perspective, because sometimes when you're in this space, as long as I've been in this space, you just presume. And that presumption was getting me frustrated, because I couldn't figure out why people weren't just, reframing their thinking. And so I just like to say thank you three for taking the time today and giving your perspective on this. And I hope everybody sees that these three are very, very valuable.
So I have to say a couple more final things, and then either I'm going to read out the big risks that I'm hearing Jeff and Becca putting in the chat here. This show has been awesome. I was watching a part of, I'm not really good at watching shows because I don't sit down long enough to do so, but part of I think it's called House of David. And so there was this scene of David fighting Goliath. And what was so powerful is that David, this little tiny puny guy, I mean, he was like depicted as maybe as tall as like from the shoulders to the head of Goliath. He was just small compared to this gigantic behemoth of a guy who was taunting, throwing insults against not just the army of the Israelites, but against their God. And that was why David said, in the name of Jesus, or he didn't say Jesus, in the name of whatever, but I come against you, and in the power of the Lord. And so he fought against this big giant. And I think, Bruce, based on what you said, I'm like, I think we need to change the name of our podcast to the Tough Love Show, because we are going to be speaking truth where people might not want to hear truth. But the reason it matters so much is that there are giants in the world of finance that seem really commanding, but they draw all the attention to the wrong things. And Bruce, I think you're right. There's so much that's enmeshed together in this idea that people are putting all their attention on, which is why we're solving the wrong problems, which is the retirement model is what you should go after, which if you're going to do that, you need a pile of cash, then you have to drain off the interest, which means you have to have a rate of return, which means I got to take off this skinny slice of my income, spend the rest because I really want to enjoy my life. And this skinny slice, I got to figure out how to work really hard, like this overworked workhorse, to make this whole mirage happen. And it's because we're chasing this giant, we're trying to attack a giant, but really that's not the real problem. None of it's the real problem. And here we are. We're going to be the Tough Love Show. That's just maybe our side title, our insider's title, if you're listening to the show, that we're going to help you to really take control, which doesn't look like probably what you expect it to look like, because we're not fighting that battle. We're fighting a completely different battle, which is the real battle that you need to be able to win in your financial life that nobody's actually talking about. So that's all I'm going to say. Jeff, do you want to say your big risk?
I was just thinking that the probably the biggest risk is when someone has the illusion of understanding. They think they know about something, they can't actually, they don't actually know it. They're using secondhand information that they've seen on TikTok, heard someplace, heard at a party, wherever they happen to hear it, but they don't understand it, can't explain it, and yet they're living their life on it. And we have to do that in certain areas of life. Absolutely. We can't be masters of everything, but we deal with money every single day, and yet people don't understand how money works. They work to make money. They work to learn how to do their job so they can make money. But the reason they're doing it is to make money, but they don't know how money works. But they have the illusion that they do because they look around and they say, well, this is what some professional told me. And I want to help people understand. I don't want to work myself into a job. I want to work myself out of a job. I want to equip them so that they can make good decisions for themselves. And I work myself into a counseling role where they're coming to me and asking me questions and saying, hey, I've got an idea. And that idea is based on truth. It's not based on dependence on somebody else.
That's awesome. Don't follow the crowd. They might be wrong. I remember this cartoon my parents had on their fridge growing up, this whole flock of sheep going over the cliff, and the one going the opposite direction looking like a lunatic, except they were the only one who was actually safe. So don't follow the crowd. Don't just listen to what everyone else is doing because that could be wrong. And the illusion of understanding, meaning you think you know the problems you're solving, you think you know what infinite banking is all about, that can lead you to this arrival syndrome and can also lead you to solving the wrong problem. Becca,
If you're solving it with life insurance, you're asking the wrong questions. If you don't understand what the actual problem is, you're asking the wrong questions.
end end of podcast. But Becca, you said there was another risk. Go ahead and share
Yeah,
that.
well, I never got to meet Nelson while he was alive, but I have heard several of his seminars that were recorded, and someone asked him the same question. They said, Nelson, what's the risk in practicing IBC? And he thought for a second, and he said, not participating. I thought that was a great answer.
Mhm.
That is awesome. That is awesome. All right, we're going to wrap here. Thank you for being with us on this extra long podcast. Thank you for joining in. Thank you, Bruce and Jeff and Becca and Joe, for joining me today. Thank you to anyone who's listened to all or part of this conversation today or who will in the future. We appreciate you for being willing to let us share some tough love with you and make some challenging decisions for yourself. Take responsibility in your financial life and clear up the real problem that you're solving so that you can be in financial control, because it is possible to have your financial life working in your favor. So if you would like to have a piece of that, if you would like to talk to our team, if you would like to start making traction in this area, you can book a call at themoneyadvantage.com. And that is to get on our advisor calendar, talk about your financial situation, and really help you to optimize and improve every area of your financial life by changing the conversation, changing the way that you're solving the problem, changing the understanding of the problem in the first place. So you might be in for an adventure when you talk with our team, but I promise it's going to be amazing, and it's going to be something that is insightful and will put you in a much better position than when you started. So thank you so much for being with us today, and we love all of your questions. Joe, you do have to end us with what you just said. The risk of infinite banking.
There is no risk.
There we go.
Paraphrasing what Becca is paraphrasing Nelson saying, it's not actually implementing the infinite banking concept. If you're actually implementing it, there is no risk.
All right, there you have it. Thank you for being with us today. In closing, please remember, success leaves clues. So model the successful few, not the crowd, and build a life and business you love. We'll see you next time.